Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Romin.
And I'm Michael.
After weeks of market turmoil, asset prices across the board are lower than they were. But is anything actually cheap yet?
We grab our valuation toolkit and go bargain hunting across stocks, bonds, and commodities to find out what's on sale. And in today's dumb question of the week, does valuation tell you anything? All right, let's get into it. So lots of markets around the world are in correction territory. They're down by double digits. And inevitably, investors look at falling prices and think, oh, it's getting cheaper. Is now the time to buy the dip? Should we start with the biggest market? Should we go S&P 500 first?
Yeah, you can bet that that's what President Trump is looking at. And that's been pretty resilient. I've been surprised by how resilient it's been, given all the news flow. Now, that's down around 8% from its peak pre-war, so that would be on 27th of February. Now, that is its worst monthly performance for some time, because we've just got conditioned to an S&P that tears upwards. So I think that has been a surprise for many investors that this has happened. Why has it been so resilient? Well, earnings for the S&P 500 won't depend hugely on what's going on in the Middle East, at least not yet. Maybe down the line they will when we get some kind of inflation shock. But for now, things like the Mag 7, their earnings probably won't be negatively impacted in the near term. There are questions about energy, chip prices, due to helium shortages. Those could have knock-on effects later on, but for now, things are still gliding along in pretty good form, as is the US economy.
But on some metrics, the S&P 500 is cheaper than it was a month ago. Should we take a look at your favourite one, the forward price to earnings ratio?
Yes, so if you're not familiar with this, you take the price of the index today and you divide it by the forecast 12-month ahead earnings for this S&P index, aggregated across all 500 stocks. And if it's cheap, it would be around 9 times, 8 times. That's what it reached after the GFC. And then if it's expensive, it would be 25, maybe pushing 30. Now, at the moment, it's about 20 times. And that's down from around 23 times at the beginning of 2026. So certainly a re-rating downwards, as it's called. But is that pricing in some kind of catastrophe? No. That's not really the case at all. So I'd just say that this is a little bit expensive compared to the long-term average, maybe in line with the long-term average.
It's in line with the 5-year average, which is 19.9, and it's above the 10-year average, which is 18.9. But remember, American stocks have been pretty expensive for quite a long time now. As you say, if there was real distress in the market, then there's a long way to fall. But what I thought was interesting is that compression of the price to earnings multiple has kind of happened for two reasons. Yes, the price has fallen a little bit, but also earnings expectations have been revised upwards, despite everything that's going on.
You can see that some sectors in the US will benefit. Energy is the obvious one, and that sector's rallied, whereas the rest of the sectors have tanked. But broadly, things like AI, which have driven a lot of the earnings growth of the S&P 500, companies like Nvidia, those are continuing to forecast pretty strong earnings growth, despite all of the worries about what's going on in the Middle East.
And yet those are the stocks which have had quite a sell-off. If you decompose the S&P 500's decline since the start of the year into those mega cap tech stocks and everything else, then the Magnificent Seven plus Oracle have accounted for 85% of the decline of the index, partly because the index is so concentrated in them.
And there was already a bit of a sell-off amongst those tech stocks before we got into this war. So it was a trend which had already started since the beginning of this year, as people, I think, were realizing that there was a huge amount of capex, capital expenditure, to do the hyperscaling. So this is more of a continuation and acceleration of a trend that was already in place. And I think a healthy one. I think people were paying too much for these growth stocks. And if anything, this has just brought things into line.
I saw a really interesting graph where if you broaden this conversation beyond the mega caps to the IT sector in America in general, then you can look at the ratio between the S&P technology sector and the multiple that's trading at versus the broad index. And if you go back to the start of 2019, that was broadly in line. There wasn't a big valuation difference between the tech sector and the S&P 500 as a whole. But tech outperformed, and investors were willing to pay a premium for it. And it peaked at almost 1.5 times as a ratio in 2024, but since then has fallen. And now they're roughly in line again. There's not a big premium for the broad technology sector.
That's a good point. And the big shocker for me is what's happening with Nvidia. Now, that has been the poster child of this huge rally that we've seen. And there was a recent thing from Goldman which said that Nvidia now trades at par or a slight discount to the S&P 500 on forward price to earnings. And that's the first time that that's happened in over 10 years. Now, this could be my final bite of the cherry with Nvidia. But you can bet, if I buy this in my fund portfolio, Laura's going to be making fun of me. It's going to tank and it's not going to work.
What could cause it to tank, though? Just a broad pullback in the economy, and therefore hyperscalers have to reduce their CapEx spending. I think the most concentrated risk for Nvidia is OpenAI, which accounts for a massive proportion of the sales it's booked going forward. Like if there was a faltering there, then that would impact them. Or I suppose if energy costs did really soar or the supply chain got mangled, then that would be bad for an Nvidia.
Yeah, or maybe competitors will come up with chips. Lots of competitors have talked about creating something which would be able to do the same thing as their GPU chips. Companies like Tesla, which said that they will try and manufacture their own chips. So perhaps that's going to be the nail in the coffin for Nvidia. Or it could just be the fact I bought the stock. That's usually the case.
Have you bought it yet?
No.
But you're right, that it does look a better entry point than it did, 6 months ago.
But I think that's a really helpful way to frame these sell-offs, which is to see it as an opportunity. Take the things which you wanted to buy, and now you can buy them more cheaply if the investment thesis is still in place.
But all those Mag 7 stocks are in double-digit drawdowns. And a lot of people are pointing the finger at Microsoft, which is down more than 35% from its peak, because it was already getting whacked by the SaaS apocalypse, because, a lot of its revenue comes from things like Microsoft Office and selling business software, which people were worried would be disrupted by artificial intelligence. And now we've had a broader pullback in risk sentiment, plus a pickup in yields at the short end of the curve. Not good for growth stocks. So if you wanted to buy Microsoft, if that was something you were looking at, it's the cheapest it's been in a long, long time on most metrics.
And just looking at the S&P's heat map, we've got this thing for the members, which is a return heat map. It's just a sea of red for US stocks over the last month. Communication services, which is dominated by Google, Meta, that's all red. Information technology, dominated by Nvidia, Microsoft, Broadcom, all of that's red. There's only one sector in green. And can you guess what it is, Michael?
Something will be wrong with the world if it's not energy.
Yes, it's just deep, deep green. Companies like Exxon, Chevron, ConocoPhillips, EOG Resources, all of them rallying hard, 10%, sometimes 20%.
I mean, it's reflected in the price to earnings ratio now. So I'm looking at FactSet's latest report, and the energy sector in the S&P 500 has a forward price to earnings ratio of around 20, so in line with the index, when previously it was trading at a quite depressed multiple. So over the last 5 years, the energy sector has traded at an average PE of 12.9. Now it's shot up to 20. I guess the thing we don't know here, though, is how accurate are these earnings forecasts. And the other thing is that the forward price to earnings ratio is really only looking at the next 12 months. You could see some long-term effects from what's going on right now.
Yeah, I think you put less faith in those earnings forecasts when you actually know the analysts who make them. I mean, they're lovely to have a drink with. Have I got much faith they can accurately forecast things? And is there some kind of adverse incentive for them to make things look good? Maybe. They certainly are quite reluctant to change their minds once there's bad news. That has been the case in the past.
So if we ignore everything they're saying about earnings and we look at other measures, backward-looking measures, on those metrics, there's little doubt that the S&P 500 still looks very expensive. If you look at CAPE ratio, for example, which compares the price today to earnings over the last 10 years.
Yeah, so that looks like it's at about 37 times historic earnings, and that's historic over the last decade. The median for that's about 17. So certainly it's been cheaper about 98% of the time over the last century.
Oh, only about 98% of the time over the last 100 years. If you wanted to make the case we're still in a bubble, that would be it, right?
Yeah, I think so. I think, you can choose your measures here and they all tell slightly different stories. In this case, a very different story. But I think equity is forward looking. So I tend to favor those forward looking measures.
You know, the thing I've been looking at, Roman, which I haven't seen discussed very much, is the price to the free cash flow generated by the index. Some people call this the free cash flow yield. And that has really collapsed over the last 5 years. And there's a structural change going on here, which is that up until recently, those mega cap stocks, your Googles, your Microsofts, your Metas, they've basically been printing money, throwing off a huge amount of cash because they had massive margins and very low capital expenditures. And their balance sheets were impeccable. There was just this money. They didn't know what to do with it. They just had so much money.
Yeah.
That's all changed with the build out of the AI data centers. Now, they're more or less spending all the cash they generate on building infrastructure. CapEx has gone through the roof to unbelievable levels if you look at the graphs. So the free cash flow of the index compared to the price has just dropped off a cliff. And I looked at this graph and I said, well, that's interesting. Let me sort of expand the time period. The last time it happened to this degree was, 99, 2000.
I knew that was coming.
Yeah.
Yeah, if you like reading corporate reports, annual reports, then this is something that you're pretty familiar with, which is that if you look at earnings, it's more easily manipulated than something like free cash flow. So that's difficult for an accountant to kind of munge.
Yeah, and I can see both sides of the argument here. Like, I'm not saying that these tech companies are doing anything wrong by throwing all their money into building out data centers. If you look at Microsoft, for example, its margins on Azure are huge, 30 to 40%. It literally doesn't have the capacity to meet demand for its AI services. If you're talking about capital allocation, why wouldn't you just be trying to build this out as quickly as possible? But there has to be quite a lot of uncertainty, I think, about whether the revenues will eventually justify all this spending.
You see, the big worry for me is this is going to get undercut by China. If you look at the number of top AI researchers, this is a graph that's been making the rounds recently. China is now by far leading that table. And this is based on first authors at this NeurIPS conference, which is an AI conference. So China's got over 2,000 first author researchers. US has 1,800 and the UK 230. So China is just plowing money into AI, but also embodied AI and robotics. So I think that's the real threat here, which is these companies are going to massively spend to try and get ahead of the game. They're going to come up with overpriced products, which can be massively undercut by China. So I think there's a real risk here for these US companies.
But at least the valuations of the Magnificent Seven have come down a bit. They're not so extreme as they were. And I'd argue there are far more egregious examples in the US stock market of things which, on the face of it, look expensive. So for the first time in more than a decade, Walmart is commanding a significant premium over Amazon. You wouldn't have thought that, would you, when you look at retailers? But Walmart's trading at more than 45 times forward earnings, and Amazon is trading at less than 25 times.
Yep, and Tesla is still at 175. So I think it's difficult to make the case that there's cheapness across the board. This is not a market without some air still in it.
The thing with Tesla is it always looks expensive. And you always think, oh, can't I just bet against this? But then betting against Elon Musk has never been a profitable trade for some reason.
Well, the multiple got down to about 93. That was in 2025. So I think that's a pretty good bellwether, actually. Look at the valuation for Tesla and see how crazy it is. And if there is a lack of risk appetite, then that suggests the market's capitulated. When the Tesla fanboys give up, that's really a very strong signal.
So it sounds like we're saying that overall, You put all that together, the S&P 500 is a little bit cheaper than it was, but it's hard to say that it's cheap.
That's absolutely true. I think it's just kind of reasonable now. It's fairly priced, maybe.
I don't think it's even fairly priced, Roman. I'd say that. Certainly compared to history.
Yeah, these things usually overshoot, so maybe you're right. So let's just step back from America and look across different countries. So it's a sea of red, obviously. Some countries impacted more than others. So MSCI Saudi Arabia is up around 3%, Argentina 1%, Norway 1%. Those are the only blue bars over the last month. Then if we look at the bottom of the table, we've got countries like Indonesia down around 10%, South Korea 9%, Germany 8%, France 7%, Australia 7%, UK down about 6%. So fairly consistent across the board. Now, generally, the earnings are slow moving. The prices obviously are very quickly moving down at the moment, as we've said. So the valuations are now more reasonable. The US is at 20, Japan at 16, UK at 13, EM broadly at 12. So really all we've seen is a re-rating down a bit. And if you're a global index investor like I am, then because of the heavy US weighting, the ACWI, All Country World Index, forward price to earnings multiple has moved down quite sharply because of the re-rating of the US. So that was nudging 20 before this war. Now it's at 17.3.
Is there any stock market you look at and think, that does look cheap and good value right now?
Maybe not yet. I just think at the moment, we've just seen a slight re-rating. That 7% move downwards has certainly made everything cheaper. But is anything looking screamingly cheap? I don't think so, not yet.
You know, the one I've looked at and thought, why is that so cheap? Is Brazil. So its forward PE at the moment, according to Yardeni, is around 9.6 times. So one of the cheapest markets in the world. And yet it has a lot going for it, given the current crisis. Its index is very concentrated. There's a lot of financials in there. And Brazil is one of the only central banks cutting rates right now from a high base. It also has big energy exporters like Petrobras, which could benefit. And it has elections later this year, which could give a market-friendly outcome. I've seen a lot of hedge funds mentioning the opportunity in Brazilian stocks, which you could either take as a positive or a negative sign. But I don't know, if I had to pick one unloved market, maybe I'd look at Brazil in my fund portfolio.
I'd love to visit Brazil, but I'm not sure I'd invest in it. It just has got lots of crises in the past.
Its stock market had a fantastic year in 2025.
Yeah, that was true of a lot of EM. EM was having a very, very good start to the year in 2026. And then, this war happened and that scuppered all of the progress.
Yeah, maybe. Maybe it's the wrong time. It's just something you said a few weeks ago stuck in my head, which is that we might see this rotation from bits to atoms. Lots of people have been talking about it. And if that were to be the case, then Brazil could be well positioned. It's got close ties with China. It's in the Western Hemisphere. Its index has basically no tech and a lot of heavy industry. But anyway, that's enough about Brazil. And I'd say that's enough about stocks for the time being. After the break, let's talk about all the other assets that are out there and whether any of them are looking undervalued.
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and one of the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 1.5% cashback on all transactions up to £15 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1 and use the promo code ROMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You are responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
Okay, so we talked a lot about the stock markets around the world. Let's look at fixed income now, right in your wheelhouse, Roman, because we have seen some quite sharp moves in bond yields.
Yeah, if you look at the gilt yield curve, for example, that's moved sharply upwards, both at the short end and at the long end. Now, if you look at the change in the value of funds, like VGov, which buys all UK gilts, that has been fairly brutal. Now, that's down almost 5% so far since the beginning of this war. And for fixed income, that's pretty shocking. But when I look at that, I think, oh, opportunity. Whenever there's a gilt sell-off, I always think, well, what are the yields now and are they attractive? And I think they are. If we looked at the short end of the gilt curve, a lot of those bonds had yields which were lower than a money market fund before this war. Well, now none of those gilts have a yield to maturity which is less than the SONIA rate. So I think that means that there are some opportunities here which you could lock in. Certainly if you're a buy and hold investor for gilts. If you're already holding gilts and you're a buy to hold investor, well, it's just an opportunity cost. You could have bought it more cheaply. And if you hold a broad fund of gilts, well, you're just going to have to ride it out. But many people bought it as a hedge for equity. And if you had longer duration gilts, that really hasn't paid off. I'd gone for money market funds which have almost no duration, and those have just coasted through this crisis with a slight gain.
Do you think the moves in yields have been too sharp, though? People have been pricing in 2 or 3 rate hikes from the Bank of England this year, which to me seems kind of implausible. I could be wrong, though.
No, I completely agree. I think the effect is going to be to immobilize central banks when it comes to policy. They're just going to wait and see what happens, because the policy in terms of politics is completely unpredictable. It changes day to day, post to post. And then the economic consequences, which come with a lag, also very uncertain, which means that things like the dot plots from the Fed are almost meaningless. Powell was saying if there was one episode of the dot plots where we would have just stepped back and said, look, we can't do it, this would have been it.
And to that point, central banks are obviously going to be looking at inflation expectations and what happens there, because that's what they're worried about. Do people expect more inflation and therefore wages and prices get pushed upwards beyond the immediate energy shock? Now, short-term inflation expectations have risen quite sharply in the UK and the US. People expect prices to go up over the next year. However, if you look at longer-term expectations, they haven't risen much. Like the market pricing thinks this is a transitory shock.
And that's true of the equity market as well. It's true of the credit market, where spreads really haven't blown out much at all. So I think there's a lot of complacency in this market, possibly correct, which is saying that this is going to be short-lived and that there's going to be a quick resolution. There has been a bit of a move upwards in break-evens. So if you look at the 5-year break-even for the gilts in the UK, that's around 3.8% as of 26th of March. Previously, it was at about 3.2%. So there is now an increasing amount of inflation being built into the fixed income space. I'd say probably not enough. And for equity, definitely there's a lot of complacency.
Do you not think, when you look at this massive pickup in yields, that markets are clearly worried about inflation, but maybe they should be a little bit more worried about the hit to growth? If we do see a sustained energy shock, then that's going to be bad for discretionary spending and could tip us into a recession. Everyone knows that. And presumably that would push yields down if that happened.
Yeah, you've got the two conflicting forces here, which might be why the yields haven't moved even further. Lower growth tends to push down yields and push up prices for gilts. So it's really a kind of balancing effect between those two. Will inflation rise more than growth falls? But a stagflationary shock is where we're at. So I think that's a real problem for the UK. Maybe a bit less of a problem for the US, which was in pretty good shape before this happened.
Are you looking at the long end of the curve? Like 30-year yields are around 5.5% in the UK. Seems high, no?
Yeah, I think that's true. And I think there are some opportunities. I can't fish in that end of the curve because I buy to hold and I'll be dead by the time those mature.
Well, you could take a punt on it in your fund portfolio if you thought there was going to be a downward move in yields.
Yeah, old man's crypto. Yeah, TR73. But coming back to the broader picture, the dollar rallied, but overall it's not up that much. So pre-war, the dollar index was at around 98. Currently it's bobbing between about 99 and 100. So is the dollar acting as a safe haven? Yeah, kind of. Gold obviously is tanked as central banks try to defend their currencies by selling their gold reserves. Plus, I think a lot of investors have moved out of it, which is interesting given the crisis. And Bitcoin is bobbing at around between 66 and 68,000 per dollar. Pre-war, it was at 87. The interesting one is the fertilizers market. So that's gone up by around 30 to 40%. Now, obviously, you get a lot of those ammonia exports coming through the Strait of Hormuz. So about 1/3 of global seaborne fertilizer comes through that strait. About half the world's urea, 30% of global ammonia exports. And that's one which most people don't talk about, but which is really important if you're a farmer or indeed someone who eats food.
Yeah, there's some uncertainty about how much that effect will push up food prices over the next year. There was a really good piece in the FT making the case that it's not a done deal that we'll see massive food inflation just because fertilizer costs have gone up, because it's not a one-to-one relationship. Like if you use 25% less fertilizer as a farmer, it doesn't necessarily mean you're going to produce 25% fewer crops.
Yeah, I'm sure it's not a linear relationship, but clearly it's not good for food prices. And food prices are really important for inflation, particularly the anchoring of expectations. So let's just hope that doesn't happen.
But is there a case to be made, if you were going to take a punt right now, to buy a broad commodities index? Because so much of the supply chain has relied on exports from the Middle East. You mentioned fertilizer, but obviously natural gas, which feeds into production of helium, which affects microchips and other technologies. Also, industrial metals rely on gases out of the Middle East. Oil, clearly. Like, there's all these things, which is really hard to think through all the implications. If you wanted to just make the bet that things are going to get snarled up, things are going to get more expensive, then a broad commodities index might be the way to go.
Yeah, I'm so glad I had gold and this broad commodities index as part of my test replacement for my core portfolio. But it's precisely for this kind of thing. In fact, you could call it a Strait of Hormuz hedge.
But if you're looking at it now, the question is, has the commodities index already priced in a lot of the worst?
Yeah, that reacts quite quickly, I think. So probably that's true. So maybe now's time to rebalance. But it certainly paid off so far this year.
Depends on the commodities index, I think, and where they're buying on the futures curve for a lot of these different materials. Because we've seen spot prices rise a lot faster than futures prices 6 to 12 months out. So the different commodity indices have moved by different amounts in the short term.
Oh, yeah. The composition is different. The part of the futures curve is different. And so you would see different responses. But broadly, you would expect to see all of them move up. The big difference usually, I think, is the energy exposure.
And also whether they include agricultural commodities. Some of the indices do, some of them don't.
Yeah, that's right. So I think it's important to be very clear which exposure you've got when you buy one of these, and also how it reduces roll cost, because that can be a bit of a drag on your portfolio long term.
So we've rattled through a lot of assets there, various stock markets, fixed income across government bonds and credit, commodities, precious metals, all that stuff. And maybe prices have fallen in some of those where the entry point looks attractive. Maybe some things are even cheap. But Romin, is that even the way you think about your fund portfolio? Are you looking for things that are cheap? Or are you more focused on themes and structural theses that you believe in long term, and you're not really focused on the day-to-day price moves?
Yeah, I do tactical stuff. But the problem with tactical stuff is that you have to watch it. And at the moment, I'm so busy because we've got various changes going on inside PensionCraft, and I had to keep my eye on that. Really positive things, like updating the trackers, and also we'll be working with someone new soon. So that's quite exciting. But generally, the way I approach this is to buy more of the stuff which I believe in. So my copper portfolio on February the 28th was up 200%. Now it's only up 156. So I'm thinking, might buy a bit more of that.
These are copper mining stocks.
Yeah, this is copper miners. It's a basket of stocks.
So your approach is basically the things I believe in anyway, if they fall in price, then maybe I'll buy more. But you're not just looking across every asset and being like, oh, where's the bargain right now?
Yeah, I've still got a grudge about NVIDIA because Laura did so well with it. So I think I might buy some of that just as a way to wreak some vengeance. But if the sell-off was absolutely brutal, I would think about getting leveraged S&P exposure, the fund portfolio, just to kind of ride things up. It's still the case that half my fund portfolio is in cash.
It just feels that we haven't fallen that far to make that kind of punt on a sharp recovery. Like a sharp recovery from what? The S&P's down less than 10%.
Yeah, that's right. Now, I would say don't get carried away with the fund portfolio in this kind of environment because it's easy to think, yeah, I saw this coming. I bought gas 3 times levered and look at me now, I'm riding high. I'm a genius.
That should have been me, Roman, but I didn't buy it.
But all I'd say is this is a very volatile environment and don't take on too much risk. I mentioned I've been burning the midnight oil when it comes to our trackers. You get access to those as part of our community. If you want to learn more about it, just go to pensioncraft.com/membership.
Okay, today's dumb question of the week. Does valuation tell you anything? Don't tell me, Roman, we've spent a whole episode talking about something that doesn't really matter.
Well, you can ignore it, and many people do. You could claim that it has no bearing on market movements, which is kind of true over the short term. But I think longer term, I'm always banging on about mean reversion, but certain things do go back to their long-term average. Price to earnings multiples, price to book values, credit spreads, all of these things tend to move back to those long-term averages. And so if you're deviating a lot, well, that tells you something. It doesn't tell you when, but it tells you that it is going to move in a certain direction with a higher likelihood than it will in another.
But if it's not a timing signal, are we purely looking at it to calibrate our expectations over the long term? So we're saying, okay, things look expensive, therefore over the next 10 years, we should expect lower average returns than in the last 10 years, something like that?
Yeah, I mean, look, if you're a professional fund manager, there's career risk. If you can't time things correctly, well, fine, you'll be right eventually, but by then you'll have been fired. And the money would have flooded out of your fund because it underperformed. As an investor, you can have this long-term mindset, which is a kind of superpower. You can say, look, I know that eventually this thing's going to be cheaper. What I would say is that you shouldn't hold money back from the market because it's expensive, because that's usually a mistake.
See, that still sounds like we're saying it means nothing. If you're not going to hold money back, if you're not going to act on it, why do you care about it?
Well, I think for the fund portfolio, this is definitely something you can act on. So, for example, if we went to an 8 times multiple on the S&P, like we did after the global financial crisis, you can bet I'd be buying that 3 times levered S&P fund.
Yeah, on the basis that you think global capital markets are not going to collapse to zero. But in the situation where we go to an 8 times multiple, which has happened once in our lifetimes, it's because the world is genuinely at risk. Like the financial system could have collapsed in 2008. Imagine that happened now, and you'd have to get through Congress, a divided Congress, all these bills to save the economy. It wouldn't be straightforward.
No, I think that's true. So there is a certain element of faith that things eventually will be okay during these awful crises, which has always been borne out in the past. But it's really about identifying those markets where these things are reversible. And in some cases, they're not. For single stocks, it might actually be the end of the company. But would it be the end of an entire country's stock market? I think that's unlikely. So as always with these things, if you have the most extreme parts of the distribution, those are usually the most informative parts. But also the parts which are most scary. Things are super expensive, super cheap, and you don't really know how to act. But if you do use these mean reversion things, it can be useful. I remember mentioning earlier this year about gold and silver, and you were talking about what would you do in 2026. And I say, well, I'd probably do some kind of gold and silver compression trade. I wish I'd done that.
Yeah. I think the way I look at valuations is if they're really high, like they've been in the US, I don't necessarily think, oh, that's therefore going to collapse, like it's self-collapsing. I think it just makes it more vulnerable to a shock like what we have now, where if valuations are stretched, it doesn't take so much to pop the bubble.
Yeah, I think that's true. There's usually a catalyst event and things just trundle along being expensive without the correction happening. And then we get these shocks and sure enough, the bubble deflates rapidly.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a Pensioncraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.